Hey guys, Toby Mathis, and today we're going to go over tax hacks for day traders, specifically what the IRS isn't telling you. Heck, what they can't even tell you, because you're going to learn is a facts and circumstance test quite often. So let's dive into kind of the different categories that you could fall into, how they're treated differently for tax purposes, what are things you could do to actually better your position from a tax standpoint, and the best path forward to you based on your facts and circumstances. So let's dive in. Number one, you hear the term trader and you wonder, what the heck is it? Let me go look in the code and see how it's defined, and you'll realize it isn't. There is no code provision that says trader. What it is people that were actively engaged in stock trading did not think it was fair that they could not be treated as a trade or business and get ordinary necessary business expenses. They were treated as an investor in many cases, which disallowed typical expenses. You could write off some margin interest, but that's about it. You're not going to get your education expenses, your subscriptions, traveling to conferences, meeting with professionals or other traders, being part of groups, things like that. Anything that came out of your pocket that would normally be a business expense. Think, if I'm stock trading nowadays, I need to have a computer, need to have a data feed, need to have probably a home office. I didn't get any of it if I was an investor. And so they started coming up with this idea of, I'm going to call myself a trader business. And what do you do as an individual when you decide you're a trader business? You write off your expenses on Schedule C. Now, the problem with trading securities is that's capital, and that's going to go on Schedule D for income. And so what ended up happening is people were writing off their expenses on Schedule C with no income. And their income, they would report on their Schedule D. And that waved a big red flag, and people started getting audited left and right. And the IRS eventually came out, and they will actually, if you go to the IRS site and you say, define what a trader is, they'll define it, and they'll say, taxpayers trading must be substantial, regular, frequent, and continuous. Taxpayer must seek to catch daily swings in the daily market movements and profit from these short-term changes rather than profiting for long-term. And they go to a special rules for trader under Chapter 4 of IRS Publication 550. And it says facts and circumstances to be considered if you're a trader. Typical holding period is number one. And I'll just give you a bright line test that the courts have already ruled on, 31 days. If your average holding period is more than 30 days, you're toast, right? So you're an investor. You're not going to be a trader. The frequency and dollar amount, the extent to which you pursue the activity to produce income for your livelihood, and the amount of time you devote to the activity. Substantial, regular, frequent, and continuous are subjective, which means you're looking at the courts to define it, and then you go through all these court cases. So why is this important? Well, let me give you kind of an example using some different taxpayers. Let's say that, and I'm just going to put these up on the board so you see them. Let's say that you're an investor. You do not get to write off your business expenses. So I'll put this down here. Expenses, no. So let's say that you make $50,000 in the year, and you have $20,000 of expenses that you could have written off because you were going, let's say that you were a member of some groups, computer, home office, all these things. You do not get to deduct those. So let's just say that you're in the 30% tax category. I'm just going to say blanket, that these are short-term trades, it's ordinary income, and your aggregate tax bracket is 30%. Let's just say that income. So we have $50,000, $20,000 of expenses, which we do not get to take. So that gives us $50,000 of taxable income that's going on your Schedule D at 30%, which would be a $15,000 tax bill. So just remember that $15,000 tax bill. Now, if we were a trader, we can write off our expenses. So, same scenario, $50,000 of gain, $20,000 of expenses. I would subtract the $20,000 of expenses off of that $50,000 of gain, and that would leave me with $30,000. At that same 30% category, we'll just use the same blank number. That would mean that we went from $15,000 as an investor to $9,000 in taxes, federal taxes, there might be some state as well, as a trader, because you're able to write off those expenses. That's a pretty big difference, and that's why people are constantly trying to make that move. I want to be considered a trader. Now, before we get in there, let's just talk about the taxation of this. Remember what I said. This is capital gains. This is short-term capital gains if you're doing active trading, maybe some long-term that are thrown in there. Long-term capital gains are taxed at either 0, 15, or 20%, depending on your tax bracket. Short-term capital gains are taxed as ordinary income. What's the difference? The holding period of a year or more. There are some futures contracts which they're partially long-term and partially short-term, but I'm just going to give you a general rule. General rule, if I am trading in the stock market, I'm buying options, selling options, buying securities, trading securities, even ETFs, I'm going to have capital gains, and that's going to go on my Schedule D, and it's going to be taxed as ordinary income at my ordinary rate if I am holding for less than a year. If I'm holding over a year, number one, you'll never be a trader. That goes out the window. Your holding period's too long, but you would be taxed as long-term capital gains, which is actually really great. It could be 0, 15, or 20% again, depending on your bracket. So the income that you're making there on each of these is going to be considered capital, which means we get capital loss treatment. So I want to make sure that we cover that too. Losses are capital, which means that you have a limit of $3,000 a year, $3,000 a year against your other types of income. So if you lose money as an investor, for example, let's say that the market shifts, it goes bad, and you end up losing $10,000, you could use the entire $10,000 against your other capital gain. But if you have extra loss, let's say I have $10,000 of capital loss, I could only use $3,000 of it per year against my W-2 income or other types of income. It's called a capital loss limitation. So both of these have capital loss treatment. And this is where it gets interesting, because I do have a category where I can actually write that off as an ordinary loss if I am a trader. And so I'm just going to put plus mark to market. And this is where you see a lot of people go when you're talking to the professionals. They're saying, oh, but if you're going to lose a lot of money, then I can have ordinary and unlimited loss against my other business income. If it's against W-2, you have an excess business loss limitation, which is like 600 some thousand. It's a huge amount, but you're treated as ordinary loss. And if you're a tax nerd, what are the two forms? This is 8949 versus I think it's 4797 for the where it's going to go on your Schedule D. All of these are Schedule D. So why would somebody make a mark-to-market election? The losses become ordinary, but what mark-to-market means is on December 31st, it's treated as though you sold your entire portfolio, even if you're holding on to things. So this could be problematic if you have a stock that goes up and then goes down right after the end of the year. You never actually sold it. So let's say that you bought a stock on, and it's doing the Santa rally on December 15th, and you liquidate it the first week of the year, but it crashes right after January 1st. You're treated as though you sold it on December 31st. And before some of you guys say, oh, that never happens, I have the chart. I'm actually looking at it right now. That's Qualcomm back in, I think it was right around 99, 2000. I don't have my glasses. I can't see the little numbers. But it went up from $28 in November and ran up to $88 at the end of the year. and then dropped again, and by October 15th of the following year is back down to $34.97. So the punchline here is they were treated as though they had a $60 gain in that year tax-wise if they were mark to market, even though they may have held on to it until it went down to $34 where they barely made anything. The tax bill would have caused them to lose money. Ooh, horrible, right? So I just threw quite a bit at you. Those are your choices. You can be an investor, you could be a trader, and if you're a trader, you make mark to market. So what are the hard rules to become a trader? So if I'm going to say, question mark, how do I qualify? Let me give you, from the court cases, some golden rules that you can follow and some guidelines. Number one, it seems like the amount of trades per year that gets you qualified is 720 trades. So I'm just going to put 720 trades. You are safe. If you're underneath that amount, you are not safe. If you're doing 300 trades, they've already said not substantial enough. You don't meet the trading requirement and the substantial requirement. Another thing they look at is, do you make your living off of it? So if it's a small amount of money, they're not going to get it. So you want it to be your source of living or a major source of your income, which flies in the face of if you're doing the mark-to-market election because you want those losses to be ordinary. Obviously, you're not living off of your trading if you're losing money. But then they go over the substantial activity test. And that substantial activity test is how frequent, regular it is. And what that means is how many days are you actually in the market? And what we like to see is about 4 days a week. And so if you look at 4 days a week, let's just do rough math. There's 52 weeks in the year. How many days is the market open? How often is it open? How many days a year? Let's say it's around 200. I would say you want to be at 75. That would be a good, hard and fast rule, 75% of those. So what does that put you at? About 150 plus. So that's your threshold, is really trading at least 150 days of the year. Please hit that, or more than that if humanly possible. You really want to be around that every day. Hey, every day I'm in the market. Maybe I take a few weeks off for vacation, what you would normally do in a job, because that's the way the IRS looks at it. Now, a lot of you guys are saying, there's no way I'm going to qualify. There's no way I qualify for trader and then this mark to market. And let me just put a caveat. I didn't say about mark to market is you got to make it in the year that you're going to have it. You have to do it at the beginning of the year. I think until you have it until about April 15th to make it before the year. So like if it was 2025, I would have to have made it by April 15th of 2025, or I make it for next year. So there's a time requirement. If you do this though, there is something interesting. There's the wash sale rule that everybody has to follow, but you're mark to market. So some people like the idea of not having to worry about whether or not they're triggering the wash sale rule. And they like to be able to over here and say, hey, I don't have to worry about it if I have the mark to market election. So there is that as well. All right, so people are looking saying, why would I want, there's no way I'm going to qualify for this test as a trader. I'm going to put 75% of the trading days, hitting that at least as a minimum to get myself into that category where I know I'm going to qualify. 720 trades, 75% of the trading days, you're pretty safe, unless it's a really small account, in which case they're going to say it's not substantial enough, right? So what if you don't want to do this? What if you say, is there an alternative? And there is, and I've gone over it many times on many videos, and that is to use an entity structure, and the entity structure looks like this. I take my brokerage, and I put it inside of a limited partnership or an LLC. If you can't see that, that just means a limited liability entity, but it's going to be taxed as a partnership. I have my corporation, and I'm specifically using a C Corp as a family office, and I'm going to make it the general partner of the limited partnership or the manager of an LLC. Both work. Some people prefer to use the limited partnership because it forces you to use the partnership nomenclature, right? You're going to be talking about terms that are partnership. LLCs can be taxed as an S Corp, a C Corp, a partnership, or disregarded. So some people go right to that limited partnership because they know that we're dealing with partnership taxation. And what we do is we have that corporation have at least 20%. I would say have a substantial chunk so that money flows up into that corporation. And I'll use our example of making $50,000 here in a second. You'll see just how powerful this is. Now, the money that flows out is just like over here. It's still capital in nature. The money that flows out of the partnership that goes onto your return, you're still just an investor. But the money that goes up into that corporation, they're getting all those expenses. Plus, they get to use something called an accountable plan, which enables us to do things like the Augusta rule, reimbursing for medical, dental, vision, 100%, being able to do an administrative office in the home. All those things become deductions to that C Corp, whereas you're not going to get the same treatment through any of these others, right? You could also potentially pay yourself a salary out of a C Corp, especially if you have other activities inside it. It's a family office. Maybe it's managing your real estate. Maybe it's doing a side gig or something, or generating additional revenue. Then you could potentially pay yourself and put money into a 401k, an IRA, et cetera. The 401k would be really powerful if you want to push money in there pre-tax. But I'm not going to get that deep today. I'm just going to say, all right, we're going to use this structure. And what this does is it makes expenses a big old yes. And I'm going to put a plus. You get the accountable plan, which is extremely beneficial. Losses remain capital. You're getting the same treatment over here. We're just letting the money run up into the corporation first. And there's two ways that the corporation makes money. Number one is it makes its interest, that 20%. So if let's use our $50,000, let's just say that we make $50,000, $10,000 of that would automatically flow up into the corporation. And that would leave us with $40,000 of taxable income. But there's another type of income the corporation makes, and that is a guaranteed payment to partner. And this is huge. For those of you guys who have accounting backgrounds, you're going to say, why wouldn't I just do it as a miscellaneous itemized expense? And the reason being is because miscellaneous itemized expenses are gone under the Tax Cut and Jobs Act, and then under the One Big Beautiful Bill Act, they were eliminated, gone permanently. There is no such thing as miscellaneous itemized deduction anymore. So in order to write these things off, you're going to have to fit underneath partnership law and a guaranteed payment to partner. Can't be related to the profit. It needs to be a dollar amount. So let's just say we said that dollar amount is $20,000 a year. So there's 20%, but first there's $20,000 per year. So $20,000 plus the 20% is going up. So realistically, let's kind of do the math in our head. We have $20,000 of something that automatically goes up. That lowers instead of $50,000, now it's going to be $30,000. 20% of the $30,000, so 6, goes up to the C Corp as part of its profit. So that means $26,000 is now deducted, and we have $24,000 of taxable income at 0.3, whatever that adds up to, right? So what is that, 72? So $7,200 of tax versus, you remember the investor was paying $15,000 and the trader was paying $9,000. So we've lowered our tax bill substantially, plus we're not going to get the lightning audited out of us for being a trader where we might not even qualify. And that's just getting started. So that is a huge tax act. We're literally cutting our tax bill by more than half just by putting together a structure. Now, there's other reasons you do a structure. I'm an asset protection attorney, so I'm going to tell you one of the big things here is nobody can get this. If you set this up in the right jurisdiction, like you set it up in Wyoming, nobody could ever take your brokerage account from you or your family. It's literally protected under statute for a charging order. They get a lien against it. That's the worst case scenario. But in my experience, having done this for close to 30 years, what that does is it forces settlements, or it keeps a lawsuit from ever happening, because not only can they not touch it, they can't see it because you can use Wyoming where there's anonymity and they don't even know it exists. So they don't even know that you have an LLC or an LP or a corporation out there in a family office. They have zero idea. They can't go look it up in a public record. You would have to tell them, or they'd have to know some other way. So that's a very, very effective tool from asset protection. Now, the other thing is you don't own it anymore. And there's the old adage, own nothing, control everything. You control the brokerage account, but you don't own it. It's not in your name anymore. It's in an entity's name. And from an estate planning standpoint, if something happens to you, now we're not in a situation where we're liquidating an account. Now we're in a situation where your heirs or your loved ones or your trust or however you set up your estate simply take your interest in that partnership or LLC, the LP or the LLC. So they would simply get an ownership in what you own. It doesn't have to be liquidated. If you're using a living trust, it doesn't even have to go through court. All of this could be private, something where you don't have to go through all this. Now, if that intrigues you, and you're saying, Toby, does this relate to me? How does this apply to me? Then I would encourage you, go down below into the comments and just write consult. And we will send you a link where you can have a free consult with one of our professionals who could look at your situation and say, does this apply to you? Here's what you could do. Here's the benefits of what you do. Does it make sense for you to implement something like this? And don't worry, we're not just going to roll our eyes back and say, everybody should be this. You know, there's always a continuum as to whether the juice is worth the squeeze. And what that really matters is, what are your goals? What are your interests? What's important to you? So for example, you may look at this and say, the tax savings, schmavings. I'm not big on that. But boy, I don't want my $1 million brokerage account taken because of something I do personally at work, or maybe one of my kids drives and they get into an accident. I don't want to have to worry about my retirement disappearing because some lawyer on a billboard decides they're gonna hammer me. Here comes the hammer. There's a guy, actually they call him the Hammer down in Texas. I'm gonna hammer you, right? He's gonna come take everything that you got. I'm gonna come and, if I can't squeeze blood out of a turnip, I'm gonna take your turnips. You don't want to be in that situation, right? And you might say, this is something that appeals to me. But the tax savings are pretty good too. Now I'm opening myself up to being able to deduct things that ordinarily, as an investor, I wouldn't get. So I'm like, okay, that's of interest to me too. Now I'm really kind of focusing in on like, okay, here's some other things that would work. Maybe you have other real estate and you already have a structure very similar to this, and you have a corporation that's your family office, and you're like, I'm interested in how I could get more money into that family corporation. I want to put my kids on the board. I want to use it to do some more, maybe you're looking at doing some conventions and seminars with your family where you're bringing them out. Maybe there's some nice locations like, hey, I want to go do a retreat and learn stock trading in Hawaii. Okay, yeah, you could do that and actually write it off if that's the primary purpose of your trip. And you could do that through a family corporation. You're thinking, how can I feed it more? This might be an avenue where you could automatically feed more money going into your family corporation so you could write those types of expenses off, especially if it's already doing other things. All of those may go into your facts and circumstances as to whether it makes sense for you. And that's what it ultimately comes down to, is what makes sense for you as an individual who is looking at this activity. Maybe you're just trading, maybe you're a real active trader, maybe you're thinking about becoming an active trader, but you don't want all of the problems that come along with trader, and you're just looking at an alternative. I would say go down, write consult down below, or put your questions down below. We're pretty good about answering questions that go in there. You could see on my YouTube channel that there's a lot of activity quite often in the comments. So feel free to go down there and put some things, and we'll absolutely point you in the right direction. And if you could do one last thing for me before you go, like and subscribe. It does help our channel and our algorithms out, gets it out there. And if you know anybody who's a stock trader, especially if they call themselves a day trader, share this video with them.